Assalamu alaikum. Assalamu alaikum, everyone. I hope everybody is able to.
Walaikum salam, sir.
Walaikum salam, sir.
Walaikum salam, sir.
Well, we will start very soon. Just have to wait for 1 or 2 minutes more so that the people who are waiting in the waiting room can join. Well, warmly welcome all of you to the webinar, Money Laundering Risk and Controls. And before I start off, I would like to extend my profuse thanks to the management of Al-Sadiq Institute for organizing this webinar. I'm really grateful for the opportunity. It's my privilege to be here with you all and conduct this webinar on this money laundering risk and control issue. I warmly welcome all of you, and I understand that there are the participants from the Gulf countries. So very good afternoon to all of you, and very good morning to those who are joining from Canada. I know at this time it would be early morning hours, and it would be really tough for you guys to keep your eyelids open and attend this webinar. So, well, I will skip my introduction because as it appears, you all know a little background of myself. So I will just quickly. My voice is not clear? Hello?
Your voice is so clear, sir.
Okay. So what I was saying was that I will skip my introduction and I will right away take you to the main slides. So let's dive into the topic and start off. Well, before we talk about money laundering risk and controls, always there are a few questions in the mind. How it started. I mean, why we have to think about money laundering, and why do we have to implement all the controls that are in place in the banking sector today? And before we discuss this, one more critical thing that we have to discuss is this, that we have to understand the difference between the compliance governance framework and the anti-money laundering program. These are two different things. Sometimes what happens that we resonate compliance plan to money laundering program. Well, compliance framework or the compliance governance framework is a very comprehensive topic. And money laundering or anti-money laundering or anti-terrorist financing is one of the component of the compliance governance process or the compliance framework. Now, coming to the historical background of money laundering, well, I remember those days when I started my career in the banking sector. In those days, what used to happen was this, that we used to fill only account opening form, and all what it used to take was to just have one introduction and a national identity card, and then one was good to go. But now what happened that after 9/11, everything got changed. And at that time, during the old days, if somebody used to imaginatively perceive about the money laundering, what comes to the mind was smuggling of heroin or, drugs, a person who was involved in those affairs. There was no concept of the financial crimes. And people used to think that if we talk about the money laundering, perhaps we are talking about the smuggling or trafficking and stuff. But then eventually, after 9/11, which was the main event which brought the changes into the banking system, the concept of financial crime came, and the definition was changed, and a lot of crimes were included under the financial crimes category. So that changed. In this walkthrough, we will also discuss definition of money laundering in detail and difference between terrorist financing and money laundering, the governing bodies which are governing money laundering, risk controls all across the globe, stages, and most importantly, key mistakes and challenges that we face in the KYC process, responsibilities of oversight of the board of directors and the senior management. And then we will also briefly discuss risk-based approach, anti-money, a little bit about the anti-money laundering program and the responsibility of the money laundering reporting officer. Well, the primitive concept of money laundering, as I discussed, was this, that people used to resonate money laundering affairs to the smuggling of drugs and stuff. And there was no concept of financial crimes that I discussed. Then the instance of 9/11 happened, and that changed everything. Eventually, what happened, the Nation Security Council passed a resolution, and the resolution criminalized and terrorist financing. And it required all the nations to implement controls in their respective jurisdictions. The US Patriot Act in October 2001. Guys, I would like to request you to please mute your mic so that distortion is not there. Thank you. And the governing bodies were formed that fostered the process. Central banks were asked to promulgate regulations surrounding AML and terrorist financing, and then have an effective oversight in their respective jurisdictions as well. Board of directors of the banks were made responsible through these standards to have an effective oversight and implement controls in banks. Compliance function was not effective in the banks and financial institutions during those times. The only, if I may vividly recall, the only thing which I recall was this, that there used to be one SBP coordinations unit or cell or division in the banks that used to take care of the regulatory affairs and fill submissions to the regulator. And the policies, procedures, control frameworks were not to this extent and were not implemented. The position of MLRO or the compliance officer, MLROs and compliance officers were limited to the SBP coordination cell and stuff. There was no concept of FIU departments to which reports of suspicious transaction activities could be submitted. So that was basically the background that changed after this 9/11 thing. It's very important to have a little background from where we are coming. So this is the brief. So let's go to the next one. What happened that after that, the concept of financial crimes came, and that extended the acts of crimes, and it included bribery, theft, corruption, tax evasion. Very recently, under the European Union 6 directive, we see that the cyber crimes are also included in the list. Human trafficking, drug trafficking, proliferation activities, terrorist financing, sanction evasion, and the money laundering was also criminalized. When we say financial crimes, basically what we are saying is this, that these acts are punishable under the criminal law in the respective countries, criminalization of these acts. And then there came one more interesting concept of the dirty money or the illicit funds. The dirty money or the illicit fund concept was like any fund or any money that is acquired by an individual or an organization which it has not earned in the due course of its business, or to which it is not the legitimate owner, is a dirty money. So that's, if you look at the list of the financial crimes which are appearing here, you will see that all these are included in those concepts falling within the purview of the definition. And then anything which is not basically earned by legitimately by the individual or business was suspicious, and it used to be considered as the financial crime or dirty money. So a very quick view at the definition of the money laundering: the act of conversion or transfer of property. Knowing is very important. Please remember this, because in our next slide we will have a detailed discussion around this. By the term knowing is this, that you can, I mean, being a banker, when we are sitting in the bank or performing the banking customer relationship under different products and stuff, we cannot say that we have just taken the documents and we don't know what is going on in the account. We are supposed to know our customers. And when we say we are supposed to know our customers, what we are saying is a bit different. What happens is this, that the people say that, yes, I know my customer, his name is this, or the company name is this, and I have all the documents, all the identity documents. But that is not enough. This is one side of the KYC process. It has two-pronged things. The other side is very, very critical. You have to know the financial universe of your customers. You have to know the financial capacity of your customers. You have to know the business universe of the customers. You know why? I mean, somebody can ask why we have to go that far, and why do we have to understand all that stuff? We know Mr. A is Mr. A. His address is this, his business is this. We have all the financial statements and stuff. We know the signatory and blah, blah, blah. But that's not enough, because as a bank, we are allowing the customers to do the banking transaction with us. So it extends to the universe of the business, the financial capacity of the individual, the financial circumstances of the individual, that will allow the institution or the organization or an individual to bank to the extent of its financial capacity and financial universe. So you have to know the financial universe, the business universe, and the nature of the business, and kind of the framework remaining within an individual or a legal person will be doing banking activities with you. So this is a critical aspect of knowing principle. So again, coming to the definition, the act of conversion or transfer of property. Because remember, in previous slide, we discussed the list of the financial crimes. So if somebody has acquired dirty money to which he or she or the institution is not the legal owner or the legitimate owner in due course of its business or the financial circumstances, then the next step is to convert it. The objective of conversion is to hide the trail, hide the origin from where the illicit money or the dirty money is derived. So this is the concept behind conversion, because then the immediate objective comes to convert it so that nobody is able to identify, pin down, and catch you. Bank has to know the financial circumstances and the customers through the identity. So these are meant by these two words. Well, again, the act of conversion or transfer of property, knowing that it is derived from a criminal offense for the purpose of concealing or disguising its illicit origin, or of assisting. So this is very interesting. The assistance is also there. Any person who is involved in the commission of the crime to evade the legal consequences of the action. So this is the basic definition. To sum it up, any dirty money or the illicit money which is to which an individual or an organization is not the legitimate owner or not the owner in due course of its business activity or its financial circumstances. The act of conversion of that money is basically is basically the process of the money laundering. We will learn what is the stage, what are the stages and the process of the money laundering. Now, very interestingly, what happened that terrorist financing also became part of significant importance after 9/11. And we all know the little background of it, what had happened and how things got changed. The basic difference between the terrorist financing and the money laundering is that money is not necessarily derived from illicit proceeds. What does it mean? It may mean that a person may be a very respectable professional, a doctor, engineer, or a respectable person, anyone, a scientist, or a person of a great respect in the society. I can not count on all the lists. But the intent of doing the transaction or remitting the funds uh, is for fostering the terrorism or a terrorist activity. The intent is critical here. Source may be legal because a person may hold a very respectable position. You cannot even think of the person that a person of this caliber or this stature will be doing this terrorist financing. But niyat, or what should you say, the intent may be different for behind the transaction. So this is a critical difference. And interestingly, um, the person who is involved in the terrorist financing may not be the beneficiary of the transaction that he or she is conducting. Example, a person in money laundering, when somebody is doing a money laundering, then he is the beneficiary. The money comes back to him, right, through the process. But in terrorist financing, it goes straight to someone else who performs the terrorist act, which is called nature of terrorist financing is linear. And in money laundering, beneficiary is the individual involved, and the nature is circulatory. It comes back. The process, the purpose of transaction is terrorist active to perform terrorist activity or to support or to foster the terrorism. So the intent is different. The beneficiaries are different. The nature is linear, straight. It's not circulatory. It's not coming back. So these are the things. It's very difficult to identify a person who is having such an intent, except this that we ask the customers to identify to write down the purpose of the transaction or the remittance when they are there. Or we can also put up checks on the beneficiary. That is another control. As I discussed in the previous slide, two things came up after the 9/11 USA Patriot Act and the United Nations Security Council resolution, which was adopted by most of the countries all across the world. And the USA Patriot Act really changed banking the world very, very significantly. What happened that, we all, I suppose, we all are bankers who are listening to me. The dollar transactions have to be settled through the Fed Reserve through a correspondent. What used to happen in the past that all the large banks used to have their branches. Those were the licensees of the USA government, the central bank, and they used to have their offices there, and all the dollar settlement on the account of remittances, import, export, or treasury deals, all the dollar settlement was done through the correspondent in USA. Now, when this 9/11 happened, it was identified during the investigation that those terrorists were funded by the correspondent, some banks. Therefore, this Patriot Act came and the major thing was this, that all those correspondents that are having the dollar clearing or their offices in the USA, they were supposed to maintain record for all the transaction, and there came a look back exercise by the Fed Reserve in past, and that look back exercise was really very painful for the banks. They started, I mean, the Fed Reserve started asking for the documents of the transactions that were as much old as 10 years or 12 years. And if you remember those old days, digitalization was not there, record retention was physical. The most of the banks did not have those the record archives that could be easily tracked back. So it was really it was really a tough time, and we know the story of the one or two large banks in the Pakistan. This USA Patriot Act really changed the world of the banking as well. Now the second, now another question before I go to another slide. You know, as a banker, sometimes we think, why and who is governing all these standards, from where these standards are coming from, and why these standards are so much applicable to us. I mean, a person who's sitting in the branch in Punjab, in a city in a Punjab province, or in Khyber Pakhtunkhwa, in far area, or even in Karachi or Islamabad. As a banker, sometimes we think, why the heck we have to do all this? From where it is coming? Why it is so important for us to do? I mean, these are the questions that usually come to the minds if we do not understand the governance structure, from where these standards are coming and why these are very, very important. Please keep in mind that almost all member countries, with the exceptions of few, signed the United Nations Security Council resolution that they will take the measures towards terrorism and the money laundering. And then there came the Patriot Act and stuff. And before that, there were Basel Committee, which had developed Bank Secrecy Act and standards on the KYC as well. So just have a look at the governing bodies. United Nations Security Council, it passed resolution that we discussed. Then the FATF was there, it was formed in 1989 by the G7 countries. It has today 37 countries and 2 international organizations. It with the 40 recommendations. So these 40 recommendations surround almost all banking products and services and stuff, and it also involved risk-based approach towards the anti-money laundering and terrorist financing, and it also calls for various other measures, these stringent measures towards such activities, criminalization of financial crimes and stuff. Then, as I discussed, there was a Basel Committee. Initially, it was in place and it formed KYC standard. OFAC came, Office of Foreign Asset Control, USA. This office is under the umbrella or under the framework of US Treasury. The two significant thing which it does is this, that they gather the data of all individuals and organizations all across the world that were involved in the terrorist financing and money laundering, and they came up with the list which was called SDN list, specially designated national list of all the countries. It's a huge list. And then they said that all the banks must filter their transaction before sending it across to another jurisdiction or conducting the transaction. They basically ask not to do any transaction with the people whose names are matching with the SDN list and the stuff. So it was a huge task that called for, previously there was not a concept of system-based transaction monitoring, but when these huge, data, it's in, I don't know, maybe in hundreds of thousands names are there. So when it came up, there came a need of automated transaction monitoring as well. And as we see in the banks, that there are the system-based transaction monitoring through the various systems like SafeWatch, Equity, Order Scan, World Check, and stuff. So we go about the screening, name screening, and everything. And then there came EU, European Union. European Union came up with its directives, and the very interesting thing which I find was this, that, and I will share the slide. I really enjoyed the slide that they came up with the knowledge-based approach. And that was really very interesting. They said that you cannot be indifferent. While as a banker you are doing transactions, you cannot afford to be indifferent about a transaction. And you cannot say that I did not know. You have to know it because the person is your customer. It is you who is maintaining the account. So it is you who has to know the financial circumstances, the business universe, the financial capacity, and the nature of the transaction that he or she or an institution will be performing. So they said that, no, don't say us that you maintain the IDs and you maintain the account, but what he is doing in the transaction with you through the banking system, which is criminal activity or the illicit fund. We don't know, but we do maintain everything. We maintain the account, we maintain the customer financial statements, and we know the board of directors, and we know who is authorized signatory. We know everything. But what he has done through the transaction, well, we don't know. You cannot do it. European Union came up with this idea. They said that you have to have the knowledge base. Your approach should be knowledge based. So that calls for the continuous KYC approach, continuity in the KYC approach. It's not like one-off thing that you will do at the time of onboarding the customers and then you will say that, oh, we are done. Let him do whatever he likes. So that was something which, and then they came up with the gatekeeper ideas. Gatekeepers, they said that there could be so many people working in your organization, like accountant, auditors, and financial management guys or other people, attorneys and stuff, who will be at the helm of affairs, who would know or are supposed to know what is going on in the account or in the nature of the transaction. So it's possible that it will pass through all the people, and the guy will be able to really sit with the piece of world of laundered money and enjoy his life with siesta. No, they said no, it's not the case. They list down the gatekeepers, and they said that these are the people who know, they have the insight. These were very interesting changes. And then they also fostered the process of the risk-based approach. They said they just don't go about the tick box approach, taking like, when we open the account, we have a checklist. You have this? Yes, I have it. You have this? There's a blah, 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 tuck, 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 tuck. They said, no, don't go like this. Why? Because facts appearing on the documents may be different from the truth. This is very interesting sentence. Why it has to be different? When you collect all the documents, you say everything is right. He's Mr. A, his business is this, his address is correct, I have visited the site, his business is there, okay, fine, it's perfect. But what he is doing with you in the bank by opening the account is critical. That calls an extra mile, and that calls you to go an extra mile and understand what is happening in the account, whether the nature of the transaction that one is performing is according to the business universe or not. That is critical. The nature of the transaction is resonating, reconciling, and connecting or falling within the business universe or not. If that is not happening, then it's a red flag. It's a suspicious activity. And you cannot be ignorant. You cannot say that I am indifferent. We have opened the account, everything is perfect, all the documents are perfect. But We will allow him to do whatever the way he wants to conduct the transaction. Same, I mean, there are these stories that you know more than me working in Pakistani banks, what had happened and how the investigations started against the different people. That is, a person of a very less caliber was having billions in the account and stuff. I don't want to go into those details. So the knowledge base that we discussed earlier, knowledge base requires you to go extra mile, a mile extra to the extent of understanding the financial universe, the financial capacity and the nature of the transactions that are being conducted in the account. That is critical aspect. So, and then there came on phase one Egmont group. This is the group which comprises of all FIUs. FIUs are financial intelligence units. Basically, these FIUs are placed under the Ministry of Interiors in most of the countries. These FIUs are the units to which suspicious transactions have to be reported by the banks. Generally, what is happening that the requirement of submission is two-pronged. One copy is going to the central banks, and the other one is going to the FI. But in some jurisdiction, it may be different. But generally, this is the case. So, Egmont Group was or is composite of all the FIUs that are working across globe. And they gather information, they cooperate with each other and they gather information. It was established in 1995 and its headquarters is in Toronto, Canada. Then there came very interesting Wolfsburg group, and we all bankers know that they came up with the questionnaires, the AML questionnaires that the banks are exchanging with each other, through which each bank is getting to know the extent of the compliance governance framework. I mean, they acquire who is the beneficial owner and what is the management, when it was established, license, audit is happening or not, and blah, blah, blah. It's extensive list. So all the information is being gathered, and this is very interesting tool of information. And then there is Transparency International. We know that it provides insight into the corruption index. Now, locally, what happens that all these governing bodies, and as you see that all these governing bodies and institutions, they are housed elsewhere. One office is in Germany, one is in Canada, one is in USA, I mean, everywhere. And guys, please mute your mic. Thank you. But how these standards, how these frameworks are implemented? These frameworks may I request all the participants to please keep their mics on mute, because that will cause this distortion. Well, all these standards are implemented through the central banks. In Pakistan, you receive it from the SBP. In Gulf states, we receive it from the different central banks in the respective jurisdiction. So basically, all those standards are translated into the local policies or the rule book standards, and then they are disseminated down to the banks for effective implementation. It is not enough to just disseminate the standards or promulgate the law. The most critical thing is to ensure that those standards are timely, adequately implemented or not. So for the purpose, there is a process that we see audits, inspections, and third-party reviews, and sometimes especially appointed auditors as well for a specific purpose. They review and then they report back to the central banks and to the senior management, including the board committees, through which an effective governance process comes, and then things are improved. Gaps are identified and addressed. Now I will come to the process of money laundering. Well, up to now, I'll go a little fast because I have a lot to cover. Well, guys, up till now, we have understood the background, the governing bodies, the concept of the financial crimes, money, illicit money. Well, now question comes how the money laundering is done. What are the stages? So very interestingly, it's you see that there are three stages: placement, layering, and integration. The most critical one is placement. You remember that if somebody has dirty money, right, it cannot, I mean, the guy cannot keep that huge dirty money under the pillow or behind the wall in the house, or he cannot dig and then bury all that money. It doesn't happen that way, right? Just a second. It doesn't happen that way. He has to he has to go out and put that in the bank, for the purpose to use it. Because in the changing world, there are so many jurisdictions where the plastic money is working very well. People do not take cash with them to buy certain things. I mean, and the money launderers have huge funds in their hands. We must not forget it. It's not We are not talking about millions. We are talking about trillions, which the size of money laundering that is happening in. So the most important stage is placement. At the stage of placement, what is happening that the people are turning up to the banks or the financial institution with the intent or the objective to enter into the banking or financial system and obtain a legal evidence. Because unless and until they have the legal evidence that their money is coming from a legitimate source, they cannot purchase anything. They cannot enjoy that money. Because wherever they go to purchase, say, for instance, a mall or a shopping plaza, or invest in the huge real estate or automobile or any industry, you name anything. In today's world, you have to appoint an attorney. You have to involve the government for the transfers. And there is a question from where the money is coming. There are the questions, there are the requirements that the evidence have to be submitted to the respective authorities, and they have to cite those evidence, original evidence, and then allow those transactions. So the objective of the person who is having dirty money is to enter into the system so that he may say that I have a bank account and I am sending you a wire transfer, or I will give you a pay order or a draft or whatever. So at the placement stage, if we have firm control, we can control money laundering or terrorist financing to not the terrorist financing, but money laundering to a great extent. After placement, what happens if suppose somehow somebody succeeds in getting into the financial system or the banking and gets the account opened or get into any other product, say obtain the loan or do any other transaction through which one he can have evidence. Then there comes a stage that she or the organization wants to go about the layering. Layering means to change the origin of the fund to avoid the audit trail. Because it's not enough that one gets the entry into the banking system. What happens that the police or the agencies will be coming after the person eventually, if not today, tomorrow. So they know it. They have to change the origin of the fund. They have to change the shape. There are different methods. But at the second stage, the change is made. The objective is to create such a situation that the audit trail is not generated. The origin is lost. So that if the investigation is conducted, one cannot go and pin down that it started from here. Third stage is integration, gathering up everything and then enjoying life. Because after layering, one has achieved a stage that he has or she has or the organization has legal evidence of money through the banking system or the financial system. The money can be invested, money purchases could be made, and the life can be enjoyed. So these are the three stages. Now, interestingly, let's learn a little about it. It says that introducing or bringing in the illegal proceeds into the financial system, as we discussed. And this is the most important stage, as I said. Examples, few examples, maybe opening bank accounts, availing even bank loans somehow. If taking the bank loan and then paying it back early, making early payment and saying that this is coming from here, I was able to, where did you get the money? I got the loan. And paying the loan with the penalties and stuff, but having a letter of settlement from the bank, purchasing different kind of financial instruments. The objective is to enter into the banking system to obtain a legal evidence, because he is having money back at home, but money is huge. He needs to, he cannot, or he, she, or the organization, the illicit funds holder cannot spend unless and until the legal evidence is there. The layering, I sometimes give example, a very good example for layering. We all know onion. We have seen onion. If you try to peel off the onion, all what you see is shells, one after the other. You keep peeling off, there are shells. There is no onion, basically. There are shells. The layering is like that. You try to get to the origin, but in the end, you get nothing. The origin is very hard to get. So just keeping in mind, see, after the stage of placement, what people do, that they start doing multiple transaction in multiple currency, cross currency. You have PKR, you go to the management, you say, well, what is happening? Is it interesting to invest these days in the US dollar? Say, oh, yes, good interest rate, and you might get the exchange differential as well. Well, okay, I would like to do it. Okay, going there. After a few days, I noted why I find that its dollar is not doing well, and I'm afraid that it will go down. So I would like to go to I would like to put my money in GBP. Okay, fine. Sir, I have the LR in GBP. Fine. And then doing other crisscross, making layers. The objective is to avoid the origin. These are suspicious activities, basically. Sometimes people are turning up that I have to send money, I have to purchase a house for my son. He is in USA. What is the amount of the house? Well, he's getting older, he needs to marry. And eventually, when I will retire, I will also go. So we have shortlisted a very good detached house over there. They're costing like $7 million. And the bank knows that everything is in order, documents are fine. $7 million gone. Next time again coming up, my daughter is also going. I mean, changing currencies, going into different transactions, and then avoiding the origin, avoiding the audit trail, making the audit trail complicated. So cross-currency transaction, cross-countries, cross-jurisdictional transactions, transaction with multiple financial instruments, changing the financial instruments and stuff. And sometimes, this also happens, the person who is investing in sometimes in dollar and sometimes in GBP, and then suddenly turning up with a new idea and coming to the management and saying, no, I thought that interest is very good, but very bad. It's not good. So I do not want to take the interest. I want to do away with this. Please encash it. These kind of things, when you come across these type of things which are abnormal, beyond normal, stop and think twice, double check, because it's not normal. People don't do it this way, right? So there are few examples of these are few examples of layering. And once this stage is passed, then things have to be integrated. Then one becomes very respectful. He's top notch. Let banks go for to do the private banking. Then one goes huge investments, and the real estate is one of the very attractive sector in which all these type of funds are deployed. The gold markets, right? The souks, the shopping malls, the industries. I mean, there is no limit. Because once you have become legitimate through the process, then sky is the limit. Now, this is very, very important, and I would request all the participants to please focus on this. I have, when I was starting off, I had given a little insight into it, but I would request that please focus on this one. Very, very common mistakes of our life when we are doing KYC. We focus on identity documents. We do not understand financial circumstances, financial capacity, and financial universe of the customers at times. I mean, I'm not talking about all. These are general common mistakes which are done in the banking sector by our colleagues. Permitting transactions that do not match customers' profile without performing EDD. I mean, this is also very significant. What happens that once the account is opened, then she, or the organization or the unit is allowed to do whatever transaction they want to do. So we have to stop and see whether the transactions are falling within the nature of the business or not. I mean, a company which is apparently having a title of a trading company, right, is doing a trading of, say, for instance, pharmaceutical products, right? And then sending the money on the real estate sale account, and we are not stopping. When we have to see whether the transactions are resonating to the nature of the business or not. This is very, very critical. And then not only that, we also have to see whether the transactions are falling within the financial capacity or not. I mean, financial capacity of an individual is, say, for instance, $100 million, and he is conducting continuously transactions that are going beyond $500 million mark, say, for instance. And these are the flags. It's not that we always end up with, oh, he's our net worth client. He is our net worth client, but are the transactions matching the profile? Are the transactions falling within the financial universe or not? Because these are going beyond the financial circumstances, going beyond the financial capacity, then management must perform EDD. We will learn what is EDD when we go ahead. So, and then very, very important, not understanding the difference between facts and truth. Please remember in your life, facts are different and truth is different. Facts are maybe what you see on the documents. Everything is right. Name, right. NIC, fine. Passport, fine. Address, okay. Company registration, okay. Blah, blah, all the tick box, tuck. Everything is fine. The truth is what? Truth is this, that in the account, something is happening which is not relating or resonating to the nature of the business or the capacity of the individual. So the facts may be different and truth may be different. You have to be cautious about this. Practicing a tick box approach will not work. It will only give you a comfort towards the customer identification documents, but this is not KYC. We have discussed it earlier that the knowledge-based environment is totally different. You cannot, as a banker, you cannot afford to be indifferent or ignorant to the financial capacity and financial circumstances of your customers. Not staying up to date, lack of understanding that KYC is a continuous process. Why it is a continuous process? It's very painful. I remember when I started off my career, in my early 20s, life was very simple. We just used to open the account and then we forget. We used to take out the files when the audit used to come only. There was no customer profile in the system. There were no system actually at that time in the banks that where the profiles could be maintained. I mean, the concept was not there. We have discussed it earlier when we were discussing the primitive concepts around the money laundering and stuff. Now, consider that KYC is not a one-off task. It's a continuous process. Why? The business circumstances are dynamic, not stagnant. You maintain the business accounts, business nature of the business transactions may change because competition may change, market forces may change, business circumstances of your customer may change. You see, everything is dwindling. Nothing is stagnant. So if the business conditions are not stagnant, changing and dwindling with the thump of every day or every month, to say, how can your KYC profile may remain stagnant in the system? But we have to understand as a banker that this KYC is a continuous process. And when we say that the KYC is a continuous process, we have to understand that we have to keep ourselves updated. Updated of what? Not only with the documents, as I said. I would be really very happy if you guys take this today, that it's not about the documents. You have to be updated about the financial circumstances because financial circumstances are dynamic in nature, right? And always remember, the facts may be different and truth may be different. Now, the customer due diligence. Well, we all know CDD and EDD in the bank. Customer due diligence is CDD. There are 7 elements. Full identification of customer and business entities, including source of wealth, when appropriate, and the development of transaction and activity profiles in the system of customers' anticipated activity. Yeah, this anticipation is critical. I mean, when you are making a profile in the system, you have to consider and take into account that the customer may not, as the business is, as I said, the business is dynamic. So you have to reasonably calculate what will be the anticipated transactions of the customers and what will be the range, the amount, number of transactions, and the number of debits and credits and the jurisdictions that will be involved. That assessment has to be made, and the customer profile should contain that. Well, assessment and grading of risk that the customer or the account present. Account and transaction monitoring based on the risks presented. I mean, you have to categorize high, medium, low, and then accordingly you have to apply your due diligence on the accounts. Documentation of findings and stuff. I mean, basically the CDD is done at the time of onboarding and when you update the documents and take into account information for the customer profiles. This is very important, as we discussed, that knowledge base is critical. European Union came up with this idea that you cannot, as a banker, you cannot afford with the willful blindness. Willful blindness is what? We all have played one game when we were young, hide and seek. But we all remember when we are blindfold, we are always able to see it from the side. We know who is hiding there. But we keep saying, "Main aa jaun, nahi abhi nahi." Right? You remember? We know who is hiding where, but we pretend as if we don't know. That is called willful blindness. In the context of this standard, what is being said is this: that don't act willfully blind. You know what is happening. Why? Because it is you who maintain the account of the customer. It is you who allow the transaction in the account. It is you who is supposed to know your customer well. It is you who is supposed to keep yourself updated. while you are maintaining the relationship with your customer. So this is a very interesting phrase which has been used by the European Union, that bankers cannot afford to be willfully blind. Deliberate avoidance of knowledge of facts, purposeful intent. Remember, no regulator in the world spares a bank if the willful act is identified. Mistakes are pardoned. Inadvertent mistakes are sometimes pardoned with warnings and little penalty and stuff. But if there is a proof that a willful, committed, purposeful, knowledgeful act is conducted by a bank towards money laundering or terrorist financing or towards fostering or assisting or in any manner whatsoever, falling within the cognizance and in the falling in the definition of the money laundering and terrorist financing, if that is pinned down by the regulator is not going to spare. This is a critical most aspect. Purposeful indifference. What is this? Take the example of a person who was standing at a crime site. He saw everything happening. But when he saw that the police is coming, he took 5 steps aside. And when the police asked, "Did you see anything?" Then he started swearing. Swear, I swear, since I'm standing here, I have not seen anything. Yeah? Purposeful indifference. You know, but you are purposefully indifferent. So these two things are very interesting. And no regulator spares its licensee on these two things. Key KYC challenges. Yeah, this is very interesting as well. See, suppose if, suppose if a person is in the list of OFAC, or an organization is on the list of terrorist activities, right? What they will do? They'll keep sitting with this name, with this development. What they will do, that they will change their identity. Anybody who has illicit fund or dirty money or involved and see that the name is appearing in the SDN list of OFAC or in the list of local regulators, in the blacklist of the local regulators, or in any other list of any country, they will try their identity because they cannot survive. They will be so naive, so stupid not to do it. We should think about it. So they will change their identity. Legal persons or the business entities would also do the same thing. They will change the identity document. They will come up with new names. And that is the reason why you see, for, I don't know, from 2001 onward, we are maintaining all these lists and stuff, but we are always searching for those matching names and ending up with the false positives most of the times. So what I'm saying is this, that those who had their names in the list by now, since it's now more than decades, they would have known that their name is there. And if they are not caught, this is a signal that they have changed their identity and they're still there, enjoying life. So we have to keep in mind, it's very difficult, easier said than done to identify someone. But during the course of your interaction with the customer or going extra mile, doing extra due diligence, maybe you get a thread through which you are able to identify that it's not matching, it's not reconciling with the facts which are presented, and then you go extra and then you end up with some suspicious that may lead you to pin down those entities, right? Complex ownership structure to avoid the beneficial owner. Beneficial ownership is required to be declared. So what happened that the organizations changed the ownership structure. Generally, 10% of the share has to be a beneficial owner. So what people do, that people divide it into different structure below, avoiding the threshold and then avoiding the declarants. More interestingly, there in some countries, in some jurisdiction, there is a local law that does not allow certain organizations, certain licensees to public in financial information for the public and the stakeholders. One example is for the offshore banking unit. So, and then there is a law that is called Public Data Protection Law, PDPLP law, that also restrict sharing of the information between institutions and cross-border and stuff. So that is also the case. Cross-jurisdictional. Hello, I would like to request the participants to please keep their mic on mute. Thank you. So there are jurisdictional relationship where you don't get to see the customers face to face, and you are in receipt of the documents emanating from those jurisdictions, and you are unable to identify the validity and authenticity of those documents to an extent that you may have the required comfort. But what happens is this, that there are the ways that you get, if you have your network branches, you can, well, what you can do, that you can ask the customers to go to the branches, those branches see and mark the original scene stamp on all the documents, see it for you, but you are not there to engage with the customer. Or in cases of when your branch is not there, then you have the legal attorney or the embassies of your country in the respective, but the procedure is so peculiar that, I mean, so at the end of the day, even if you are getting all those documents emanating from the embassies or the legal attorney or from other resources, other licensees, with all stamp and stuff, blah, blah, but in the heart of your heart, you are not comfortable. You cannot have a comfort because you're not there. So that is also one of the very riskiest things. Accounts open through eKYC. This is a new concept, but again, it has few things to go further. Now, come to the risky areas. Correspondent banking relationships, very risky. Why? Because you are dealing with the customers of the customer. The bank with whom you maintain your correspondent relationship may have millions of customers, and their transactions are processed through the correspondent channel, and then you get involved. Either you are paying it out or you are sending across money through them to someone else. It's a two-way relationship, but the relationship is having customers of the customers, and your correspondent may not have the effective due diligence, the way it should have been done to make you satisfied in due course. Then there comes a private banking. Private banking, the high net worth clients, the bank relationship manager has to go there and cater all the requirements. And the high net worth clients sometimes do not provide the required information easily. And the bank is always, restrictive in their approach towards private banking clients, because they do not want to lose them. On the balance sheet side of their bank, the number that is appropriated towards the deposit is so large that you cannot afford to say bye to those clients at times. So it becomes very tough for the bank to get the required documents, evaluate, and then becomes comfortable. Offshore banking, as I discussed in the previous slide, there are the jurisdictions where offshore banking units are exempted from publishing the financial statements and financial information about themselves. So everything remains under the cover. But if you have to deal with them, then the risk is high. Transactions with the money services businesses, the exchange houses. Exchange houses in few jurisdictions, there are few jurisdictions where MSBs are governed very effectively by the regulators. But there are the jurisdictions where MSBs are not that much governed. And the risk is what? If you are having, as a bank, if you are having an exchange company account or an MSB account, you are processing the money that may come from a money launderer through the company, or illicit money can come through your banking channel and may involve you and may expose you to a greater risk of being identified, pinned down by the regulator, and then charged. Because in exchange companies, you know how the business is done. A lot of people are coming, less KYC and less documentation is there as compared to what we see in the banking sector. Trade-based money laundering is another very critical thing. We will discuss in the next slide how it is. There are transactions in high-risk jurisdictions, transactions with sanctioned countries, sanctioned nationals, wire transfer, cross-border, third-party services, third-party payments, bill through account. This PTAs is like, suppose if there are the banks that allow opening the account in another jurisdiction, and the guy is maintaining the account in the home country, he operates his account here to the credit of his account in the home country. So it bypasses, therefore these PTA accounts become very risky. Well, very quick, we are running out of time, so I will try to finish it off very quickly. Trade-based money laundering is very risky. See, there could be under-invoicing. If somebody is doing under-invoicing, what will be the impact? Less duty will be paid to the government, tax will be avoided. Payment will be, the remaining payment will be shared through hundi or through other illicit means that will remain hidden. And it will not come through your proper banking channel, right? Over invoicing is also like that. Something which is $10 is being sent for $20, extra money is gone. Instead of putting efforts to open the account and do the layering and stuff, just if people get succeeded in this, then the extra amount is gone. And that will be shared by both the beneficiaries who are sitting in two different places. Undershipping, overshipping, less quantity and excessive quantity, phantom shipping, false documents basically. No, nothing is done, but money is transferred. Falsifying description of goods, poor quality of goods, paying extra. I mean, it becomes very difficult. We can say that we deal, as a banker, we deal only in the documents we cannot identify it, but it's a tough call. But what I'm sharing is that this is also being done. I know that there are standards. By standards, we cannot go and check the quantity and stuff, but this is one of the things which is happening as well. Trade not making economic sense. Like I discussed, a trading company which is having a pharmaceutical business is bringing meat with $1 per kg. I mean, does not make sense, but these things happen. So one has to be very cautious to pin down all these things. Trade not fitting to the nature of business, very critical. I mean, as we see that business is different, but what is happening in the account is different. So it does not resonate, does not relate, does not commensurate to. So these are the red flags. Trade through shell companies, companies that are only on the papers, do not exist anywhere on the earth. Transaction with sanctioned countries, we all know, very risky. Third-party payments are very risky. Now, controls could be what? Check the price. Invoice, bill of lading, packing list, three things match it. These are the common things. Vessel tracking, sometimes to check whether the vessel is heading towards. So, I mean, there could be some instances where one vessel is starting off from the Singapore, say for instance, or Hong Kong, and ending up in North Korea. So how would we know if that is taking that route, or a ship is starting off from Dubai and ending up from in the open sea to Iran or Syria, wherever to the sanctioned area. So for that purpose, there are the controls that we go for the International Maritime Bureau ID, TrackWell or VMS or Sea Search stuff. These are the companies that provide the proper tracking of the vessel where it has been through the course of voyage. So we are able to pin down if it has touched the sanctioned jurisdiction, and we can be on alert. The world check to know whether the shipping company is genuine and it is not sanctioned or not coming on the blacklist and stuff. And above all, perform EDD. Whenever there is a suspicious, you will have to go extra mile to pin down if there is something fishy. There are, now that we have understood what is money laundering and stuff, with this little background, see, very few. I mean, these are not all, these 5 things are not all items, but just few, because we have very limited time. We cannot go. I mean, each product, remember that each product has its own dimensions of risk attached to the money laundering or terrorist financing. We cannot discuss due to the shortage of time. Very quickly, we will just glance at these 5 things. Structuring. There are thresholds defined by the local regulators everywhere, right? Generally 15,000, 10,000, or even low, right? In some countries. What people do, if they do any transaction above that, they will be screened, they will be searched, they will be pinned down, questions will be raised. Where are you getting this money? What is the source of funds? So what is the best idea? Send the money below the threshold so that it passes through the system and bankers do not ask a question. So that is called basically structuring. Designing a transaction to avoid triggering a reporting or record keeping requirement. Smurfing. It involves multiple individuals doing multiple transactions, but the objective is one, making like many people, instead of one person doing, suppose if the threshold is $10,000 and one person is doing 9,000 every time, he will be pinned down. So instead of what? 10 people doing $8,000 transaction going to the same beneficiary. Ponzi scheme in Pakistan, we have seen it. I don't know. If I may recall correctly, forgive me if I am saying something wrong. There was one scheme which was called double shah. I may be wrong. Please forgive me. I do not remember it correctly. The guy used to do double the investment, and he used to lure people away, innocent people away, who used to think that their money will be doubled. In a short span of time. He used to promise that in 3 months your money will be doubled, and 6 months it will triple, blah, blah. So that kind of thing, that use of new investors, and how that is managed, the use of new investors who pay off their money is used to pay off the older one who are coming up for the increase. Free look period, generally for the insurance policy, there is a free look period. What people do, that people go buy a very huge insurance policy, and then after a little time, they go and say that I just want to cancel it. Why you want to cancel it? You know that there will be a hefty penalty on that account. They say, I'm willing to pay the penalty. No issues. Sir, do you know that this insurance policy is covering your family, your business, your entire lifespan and everything, that gives you great comfort? I say, no, suddenly I have come to know that, yeah, this is not according to Sharia. So what I have to do is this, that I just want to be rid of it, cancel it. During that free look period, it is cancelled, and then he has a cancellation letter. So that also form an evidence and goes in his file. Early redemption, same the case. Somehow, if somebody manages, I mean, after the stage of placement, if somebody gets into the system and get a bank loan, coming to the bank and saying that I do not want loan, I want to buy, I have got my issue resolved, suddenly this happened, that happened, and I want to really settle it down. Bank says that you will be paying this much, this much, this much. I am willing to pay, no issues. Only. He pays off and he has a letter of settlement. So he can say that where did you get this? I got it from the bank loan. Okay, fine. From where? How do you manage to get the bank loan? Then there is another thing. It's kind of we understood it during the layering process. That works. Sanction monitoring. The sanction is to avoid involvement of transaction, financial or otherwise, and with individuals and governments and entities that are sanctioned. Generally, we have a United Nations Security Council, European Union, OFAC, and Her Majesty UK. State Bank of Pakistan is also having blacklist people and organizations that are falling under NATCA. So these are the journal bodies from where this is coming. When CDD is performed, it's when you are established, when you have to update, significant transaction takes place, a material change, and when if suppose if customer documents or his business universe is changing substantially, when you have doubts about the adequacy of previously obtained information, if one-off transaction is going beyond the threshold, I mean, then you have to go for it. So when the EDD is performed, what is meant by EDD? EDD is basically doing extra. When there is a suspicious that may be due to the one-off transaction or during the CDD process, it may, during the CDD process, you may come up with certain red flags that may require you that you are not satisfied and you want extra information from the customer to be satisfied. Under those circumstances, you go for extra mile and you perform EDD, right? So types of additional information may be the additional information about the source of wealth, source of fund and stuff, right? Employment and business related information, a personal reference, your personal visit or whatever. But the requirement, the key thing is this, that please remember, under the circumstances, the requirement of EDD may be different, may differ from case to case and business to business. Always keep this in mind. There is no hard and fast rule that you will see this and then you will go towards EDD. No, it may differ from case to case basis and circumstances to circumstances basis. Now the responsibilities. The board of directors have responsibilities to govern and have an effective oversight with regard to compliance governance process framework, one of the component of which is money laundering and terrorist financing. Senior management has responsibilities to implement policies, procedures, frameworks, controls, top down, all across the organization to ensure that the adequacy of the compliance governance process and the controls thereof are well implemented all across the organization. There is a compliance group, and that compliance group is basically responsible to implement the compliance governance policies. There are MLROs. These MLROs are responsible to identify, document, and report the suspicious activities of the taking place in the customer's account during the course of their relationship maintenance. Compliance is responsibility of each and every staff member. It's not like there's sometimes there is a notion that the compliance will be done by compliance. This used to be in the early times, but now things have improved, and I believe that there is a better understanding. But still, sometimes I come across the instances when the people do not have the fair idea, and they think that the compliance is the responsibility of every of the compliance people only. But the thing is this, that the bank's policies, procedures, products, business, everything is taking place at the business end, at the front end. And it is the business that is responsible to govern, right? So it is responsibility of each and every staff. Compliance has its responsibility, but the business has its own responsibilities. Now let's see how the compliance fits in the governance process. If you look at the governance process structure, you have the board of directors, then the policies are formed, risk management, control environment is done. It starts from the strategic direction, and then the policies, risk management, controls, and then there comes the assurance process. Internal audits are basically, these are the people who provide independent objective assurance. But and there is another another string, which is compliance. Compliance also provide assurance, but not independent in the same fashion the way the internal audit does. But there is a concept of conflict of interest. If the compliance has to perform tests, it cannot be part of the business, or it cannot be part of the operation. Therefore, there has to be an independence completely on that account. So this is basically how it works. There are three lines of defense. Uh, there is a first line of defense, which is business operation. Basically, they are primarily responsible to establish and maintain compliance all across the organization. There is a second line of defense, which is called compliance. Compliance reviews, performs compliance tests, and reports suspicious activities if there are any. There is third line of defense that is called internal audit. Internal audit, as I said, that providing independent objective assurance. Objective assurance, by objective assurance, what we mean is this, that they review periodically or according to their internal audit plan, and they provide an assurance to the board that the objectives, business objectives, were achieved effectively, timely and effectively. By effectively, we mean cost effectively and time both. So there are three layers in the organization: the first line of defense, second line of defense, and third line of defense. And this is risk-based, under the risk-based approach, basically. So the concept that the compliance is the responsibility of compliance only is absolutely wrong. There is a first line of defense that faces the customer, interacts with the customer, establish the relationships with the customer, maintain them, improve them. They are dealing with the customers. And there is a compliance who is reviewing the transactions, performing tests, identifying and reporting. But when we discuss it, please do remember that anti-money laundering program is one of the component of the compliance governance process. Compliance governance process is very wide. We are not discussing it here. Maybe during in future, when I conduct another program, I will be able to conduct a program on the compliance governance framework. Then I will be able to define how it sits in the compliance framework. Let's see it from another angle. Remember two things, very, very interesting. This governance process, risk and control, assurance process, right? The review is post facto, right? Review by internal audit is post facto, whereas the compliance is reviewing the transactions through the transaction monitoring system concurrently, right? This is the difference. Management ensures objective achievement by taking actions. They ensure. Assurance is different. Internal audit assures by reviews and assures whether objectives are achieved or not, right? Assurance is post facto. Assurance is not real time. That's why audit comes periodically. Compliance is comparatively concurrent. However, compliance also provides assurance to the board, to the compliance committee of the board. They affirm whether the compliance governance process is being implemented and the adequacy of the controls are in place. And if there are any risks or the gaps, they place those gaps and the risk for the review of the board. And then it's a continuous process which takes place every quarter. Basically, why there are different lines of defense to avoid the conflict of interest, and the reviewers must be independent. Reviewer cannot be part of the management of the operation, because if they are part of the management or the operation, then what they are reviewing? They cannot review their own work. They cannot audit, or they cannot provide assurance of their own work. So basically, that is the idea. Well, compliance culture, this is a term which is used everywhere. The compliance culture comprises of all the people, the board, the senior management, the staff, everyone. And since the compliance is the responsibility of everyone, by compliance culture, what we mean that we have an excellent understanding in the organization about the compliance objectives, about the control frameworks, and a common objective that we have to safeguard interest of the organization. And then when we all move towards, everybody moves towards this objective in the same direction, then there comes a culture that everybody is heading towards the same objective with the same attitude in the letter and spirit. So that is what is meant by this. AML program, it has 5 standards. There has to be a compliance officer, policies and procedures, customer due diligence must be there, training must be there, and independent audit should be there in the compliance as a minimum. These are the pillars which the component that AML program must have under these standards. Before one develops a program, anti-money laundering program, one has to thoroughly understand the business universe. Why? Suppose if I am sitting in XYZ bank, I cannot implement everybody's or other bank's AML program in my bank. My business universe is different. My jurisdiction is different. My products may be different. The nature of the customers may be different. My competition may be different. The risk attached to my business may be different from the other banks. Therefore, it's not like that I will juxtapose my bank to other bank and say that that bank has developed an excellent program. Please bring that one here and implement it here. No, that's not the risk-based approach. Before we go towards a risk-based plan or a program towards anti-money laundering, we must understand the business universe, then the jurisdiction, then the requirements, and then there are certain standards that have to be fit in the plan to make it effective. So when we say that we have to understand the business universe, what it takes. It has certain components. Generally, all the banks have. There could be more or less, but generally, as a minimum, we have the finances, deposits, trade finance, interbank borrowing, interbank placement, the treasury stuff, investments, and the remittances, right? So the risk-based anti-money laundering plan should start from performing the risk assessment. That is, lay the foundation for the risk-based approach. Basically, the products, as I said, that the product system, jurisdiction, regulator, everything is different. So here it comes that the components of the risk assessment should, as a minimum, involve all these standards. Identify, categorize, and rate the risks, and then develop and implement a risk-based anti-money laundering plan. Then after this stage, transactions have to be monitored. And we discussed that there are the huge lists of millions of people which no human being can manually sit and do. So there is a need of automated system that should monitor the transactions that are taking place. So what is happening, that there is a core banking system in every organization, and there is an automated transaction monitoring system for money laundering that sits in between, talks to the core banking system, and all the transactions that are taking place, those are filtered down here. If any transaction is not matching to the customer profile, that is thrown out, and that is placed before the MLRO for review and clearing, or going forward with the further investigation and reporting. So that is how it works. As I said, resulting the transaction monitoring process, then there comes a stage where we have to either identify suspicious activity, investigate, and escalate. If we are satisfied, then we clear as compliance guys, as MLROs, we clear the transaction, or we report the STRs to the FIUs and the central banks. Thank you very much, guys. I hope you enjoyed. Actually, the time was very short. I really could speak all the day off about these things, but during this time, I think I have already exceeded the time by 30 minutes. So my profuse apologies to the management. We did not really realize that we were marching beyond the given time. Thank you very much. I'm profusely grateful to the management of Al-Sadiq Institute again. It was my pleasure to be there with you guys. And thank you, the participants. I'm grateful that you were there.
Najmi Saab,
And
sorry for interrupting. Can we please take some questions if students were asking something in chat box? But if students want to ask something, they can open their mic or ask questions if you allow.
actually, I have to be somewhere at 2 p.m. and I have to travel. So I don't know how will I make it. I did not look at the clock. It has really gone beyond that. So
Mohsin, I think,
is it possible that
sorry, Mohsin, Assalamu alaikum, Najmi Saab. Mohsin, I think, Alhamdulillah, everything has been already been covered up by Najmi Saab. So the questions will be clarified in due course.
no?
So I think,
Do one thing. Do one thing. Give them my email, and what can they do? That they can send that across to me through the email. I will get in touch with them, and I'll be there one-on-one with
grateful,
them
sir.
on all.
Grateful, sir.
Okay.
Sir,
Grateful,
please
sir.
share
Thank you.
your
Thank you.
presentation with us also.
All right. All right.
Thank you, sir.
Thank you so much, Najmi Saab. Thank you.